Greetings, everybody. Welcome to Liberty Call for January 14th, 2025. Hope everyone's having a fantastical day out there. It's a pretty nice day here in Colorado. The high was only about 30 where I'm at, so it's quite chilly. All right, well, China's financial sector is getting a major shakeup as Xi Jinping replaces key leaders with party loyalists. Meanwhile, the G20 is pushing for broader climate transition plans, and the UK economy continues to struggle with inflation, a weak pound, and rising borrowing costs. Back in the US, stocks rose slightly on positive inflation news, but Capital One is in hot water with the CFPB lawsuit over deceptive savings practices. And Bill Ackman is making big moves to turn his firm into the next Berkshire Hathaway. So let's dive in. But before we do, I need some help from you. If you could give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. All righty, well, let's hop into today's markets. Dow Jones was up 0.52%, 220 points, closed at 42,517. S&P 500 up 0.11%, 6 points, closed at 5842. NASDAQ down 0.23%, 43 points, closed at 19,044. The VIX was down 2.5%. Today, it's at 1871. Canada up 0.21, Brazil up 0.3, and Mexico up 0.14. Going to Europe, Germany was up 0.64, the UK down 0.28, France up 0.2, Netherlands down 0.03, Spain up 0.55, Italy up 0.93, Switzerland down 0.01, and Portugal up 0.73. Russian exchanges down today, MOEX down 0.11, RTSI down 0.81. And the overnight markets, the Nikkei was down 1.92%, Australia up 0.48, New Zealand down 0.05. In China, the Shanghai was up 2.54%, Shenzhen Component up 3.77, China A50 up 2.08, DJ Shanghai up 2.76, Hang Seng up 1.83, and the Taiwan weighted up 1.37%. So a pretty good day there in China. The rest of the world, it's kind of all right. So, all righty. Good stuff, right? Yeah. Beard looks much better today. I whacked it off that sounds bad. I chopped it off yesterday after the broadcast. Then I had hair all over me. I was itching all day, or all evening. I mean, a lot of times I'll, take a shower, get my beard all nice, and then I'll trim it, and then hop back in the shower, and then just rinse all off. And but yesterday I was already dressed, and so I was like, well, I'll just trim it and just deal with the consequences. But God, it reminds me back when I had hair on my head, I would just itch the entire day after getting a haircut. All right, well, let's get into the market recap. U.S. stocks reversed gains as further inflation data is eyed. U.S. stocks declined on Tuesday, surrendering earlier gains despite a cooler than expected producer price index report that as investors remain cautious ahead of upcoming inflation data and earnings season. The December PPI rose 0.2% month on month, below the anticipated 0.4. On a yearly basis, the index climbed 3.3%, cooler than the expected 3.5%. The report eased concerns over runaway inflation, pausing the rise in Treasury yields, though the 10-year yield tested session highs as traders awaited Wednesday's Consumer Price Index report for further clues on the Federal Reserve's rate path. Recent strong payroll data has already cemented expectations for a lower pace of Fed rate cuts this year. Moving on, Applied Digital Corp surged 11% after Macquarie Group agreed to invest $5 billion in the company's artificial intelligence data centers, taking a 15% stake in its high-performance computing segment. The investment boosted the digital infrastructure stock more than 6%. Boeing Company slipped 2% after reporting that it delivered just 348 planes in 2024, a one-third drop from the prior year due to production issues, including the Alaska Air door panel incident and a machinist strike. Bloomberg reported that President-elect Donald Trump's economic team is considering a gradual tariff hikes to increase, to increase leverage with trading partners. The plan proposes monthly increases of 2% to 5% under the International Emergency Economic Powers Act. Trump has pledged to impose steep tariffs on imported goods, particularly from China, which could trigger inflation and delay Fed rate cuts. Earnings season begins. My nose is itchy. Major Wall Street banks, including JP Morgan Chase, Wells Fargo, Goldman Sachs, and Citigroup, will kick off earnings season on Wednesday. Signet Jewelers Limited fell 24% after cutting its fourth quarter guidance due to weak holiday sales, while Lululemon Athletica dropped 3% despite raising its earnings outlook. KB Home rose over 2% after exceeding analyst expectations in its fourth quarter results. And that is the market recap, folks. Feel smarter? I know I do. All right, well, let's dive into that data. Right, the producer PPI from First Trust, Mr. Andrew Opdyke put this report together. Producer prices ended 2024 with a modest 0.2% rise in December, coming in below expectations, but remaining elevated at 3.3%, higher than a year ago, keeping inflation concerns front and center for the Federal Reserve in 2025. Energy prices led the increase, with gasoline prices surging 9.7%, while food prices fell 0.1%. Excluding volatile food and energy components, core producer prices were flat in December, but rose 3.5% year over year, marking a significant acceleration from 1.8% the year before. Service-related inflation remains a key driver, with transportation and warehousing prices increasing by 2.2% in December, partially offset by declining wholesale margins. On the goods side, non-energy prices showed little movement. Prices further back in the supply chain rose, with intermediate demand processed goods up 0.3% and unprocessed goods jumping 3.2%. Inflation trends in 2025 will likely hinge on the service sector and changes in the money supply. The M2 money supply, which surged during the pandemic, has been gradually rising since December of 23, but remains below its peak from April of 22. A looming battle over government spending in Washington presents a risk of the Fed acting too aggressively in cutting rates if the federal spending slows economic growth. Lower rates could reignite inflation, undoing the Fed's progress in controlling price pressures over the past 3 years. Yeah, I think we're reliving through the 1970s again, at least on a kind of an economic front. We have high inflation that has been brought on by, really over a decade of zero-bound Fed funds rates after the housing collapse in the first decade of this century, and also just excess spending at the government, increasing the federal debt from, when I started in the business, I think the federal, and this was 2006, folks. It wasn't that long ago. It was almost, like 20 years, but I think the federal debt was 6-7 trillion at the time. And I remember when it was getting close to 10, and I was like, wow, there's got to be a solution to pay this off, but no one's ever done anything. All right, next up, this is from Zero Hedge. Time to put the Inflation Reduction Act on ice. So let's see what this has to say. A recent survey of respondents by AMAC Action reveals that American seniors are overwhelmingly opposed to the Inflation Reduction Act, citing concerns over rising Medicare costs, limited drug access, and misuse of funds for green energy subsidies. Yeah, that's par for the course with government. Passed in 2022 without Republican support, the IRA promised to reduce Medicare prescription costs by capping out-of-pocket expenses and limiting premium hikes. Well, see, what happens there is if you limit out-of-pocket costs, who pays for that in the end? The taxpayer. So it's really not, the drug companies are still going to charge what they're going to charge. However, premiums have risen over 400% in some cases, and many insurance companies have exited the Part D market, leaving seniors with fewer options and restricted access to care. The survey shows that 83% of respondents worry about rising premiums, while 78% oppose government subsidies to insurance companies to hide these costs. Yeah, again, because all it does is just create more debt that we have to pay off. Seniors on fixed incomes fear being priced out of their plans and losing access to critical medications. Furthermore, pharmaceutical companies have reduced new drug development due to the IRA's price controls, with reports indicating a 36% drop in drug trials and a potential loss of 135 cures for diseases. Seniors are particularly frustrated with the IRA's diversion of Medicare trust funds towards green energy initiatives like electric vehicle credits, which they see as benefiting wealthier Americans at the expense of their health care. 83% of respondents expressed concerns over this misallocation of funds. The survey found overwhelming overwhelming support, 85%, for redirecting IRA funds back to Medicare to reduce premiums and expand coverage. Additionally, 70% of seniors favor pausing or repealing the IRA to address its flaws. Many hope that the incoming Trump administration will take action to protect their health care by either pausing or fully repealing the program to better serve seniors' needs. Yeah, it's a mess. I mean, and the problem is that the federal government got involved in healthcare with Medicare back, was it 70s, 80s? I don't know. I was a little kid back then, but and then now we have Medicaid, which is for the poor, and just piled on top of that, and all these government agencies. I mean, in the last 15 years, I've spent a lot of time in doctors with my autoimmune conditions and things like that. So seeing how many I mean, I know these people that work in these offices do things, but it's a lot of the bureaucratic red tape that you got to hire all these people to fill out all this paperwork and stuff, as opposed to just treating the patients. I know it's crazy. So, I mean, like my rheumatologist is, I think there's 4 or 5 doctors in the practice, but there's probably 100 people who work there. And it's, or maybe 100's high, but 50 at least. And because they have an infusion center, they got all these nurses, I mean, yeah, that's actual, people providing care, but then they got all these back office people. And it's just, I mean, it's kind of like the financial services business, a big practice that's got, $1 billion, assets under management, and you got 20 advisors, and, you got all the support staff underneath you. I mean, it becomes a bureaucracy, especially with, all the red tape you have to deal with a practice of that size. I mean, there's a lot of red. I mean, I spent the morning and early afternoon doing tax stuff, getting all my tax and bookkeeping and things like that. So, create, have that across, 20 or 50 advisors, or hundreds of advisors, like a big company like Ameriprise or Merrill or whatever. So anyways. All right. Well, let's get to the last article here. This comes from our friends over at the Mises Institute, the Mises Wire. Should the Fed accommodate increase in demand for money? And this was written by Frank Shostak. This, again, talking about the M2 money supply and, should we increase the money supply, and, what are the benefits? I personally think increasing the money stock actually creates more problems, but, that's my own Misesian view on economics. So, all right, let's get through this. Many economists argue that the economic growth requires an expanding money supply to meet rising demand for money, suggesting that failing to increase the money stock would cause deflation and economic instability. Deflation. Who would be upset about lowering prices? Proponents of this view maintain that the Federal Reserve should inflate the money supply to stabilize prices and support growth. However, Austrian economists, including Ludwig von Mises and Murray Rothbard, counter that money's primary function is a medium of exchange and not a consumable good, and expanding the money supply does not inherently boost economic well-being. If I could pause there, because we just look at the price of gold over the last 5 years now. It has pretty much gone up with the pace of inflation that we've seen, and actually outpaced it in some, depending upon when you measure it. Sometimes it's higher, sometimes it's a little lower, but it follows it fairly close. So, I mean, if you look at things such as like oil and gas prices, things, consumer spending, the cost of goods in relation to gold have really not changed. It's the cost of goods in relation to the dollar that have gotten more expensive because the dollar has been devalued. So that's what causes the inflation. So again, I would rather keep prices stable, or as things get more efficient, prices go down. But no. Got to keep things right where they're at. All right. Historically, gold became a preferred medium of exchange because it was universally marketable. Critics of a gold-based system argue that gold scarcity could stifle economic growth. They claim that a flexible monetary system like the current fiat currency model is better suited to accommodate economic expansion. Yet we have 100+ years of an example of that here in the United States. And what have we created? A ton of debt. Things have gotten a lot more expensive, and now you've got a lot more, you got a lot of haves, but you've also got a lot of have-nots, and the middle income or the middle class is really starting to get squeezed. All right. Yet Austrian economists argue that the demand for money is not a demand for more currency, but for greater purchasing power. People want money not for its own sake, but for what it can buy. Unlike goods like apples, which are consumed when demand increases, money is simply exchanged for other goods. Therefore, an increase in the demand for money reflects a desire to facilitate more transactions, not hold more currency. Artificially increasing the money supply to meet perceived demand for money often leads to negative consequences, including inflation, boom-bust cycles, and economic distortions. Mises emphasized that the market always has an adequate money supply as long as it is allowed to clear naturally. He argued that changing the money supply does not improve the services money provides. Increasing the money supply merely dilutes purchasing power without offering any net social benefit and often results in significant economic harm. The last 15 years. In conclusion, accommodating increased demand for money through inflationary policies results in negative economic consequences. The focus should be on preserving the purchasing power of money rather than the increasing its supply. Totally agree. Again, it goes back to that same scenario where, imagine you put your, $100 in the bank today and it has the buying power of $110 in a year. So you could say, put that $100 in the bank and say, you know what? I'm going to buy that, I don't know, picture or something for, it costs $100 now. But in a year, if I wait, I now have $110. And, if say it's just your $100 just stayed $100 in the bank, but the price of that good went down to 90. So now in the end, you still have $10 left when you go and you buy whatever that is. So that's considered a low time preference where you wait, you wait for things in the future. People with a high time preference want things today and oftentimes at the consequence of their futures. So, all right. Well, that's everything that I had to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. That's where you can go get all your financial planning needs addressed, get on track for retirement, plan for your kids' education. I wouldn't send them to college, but get them educated because they always are going to need skills. All right. Well, hope everyone has a wonderful evening and I'll talk to everyone again next time. Adios.